Good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we start off this week on a relatively good footing after last week, which started off on a much shakier footing, but ended up being one of a relatively strong week last week. We had the Nasdaq 100, the tech-heavy Nasdaq 100, leading the equity markets higher. We basically saw strength across the board: small cap, large cap, value, momentum. Pretty much all kind of factors it performed well last week. We saw market breadth continue to improve. The VIX closed, close to around 15%. Put call ratios fell, and basically overall markets went on the offensive. You had all of the leading sectors: consumer discretionary, technology, leading the markets higher. We did see some of the interest rate sensitive sectors like home builders lead the markets higher, as expectations now are for a fairly certain rate cut here in September, and following two more rate cuts in October and December. That is what the bond market is pricing in right now. Now, obviously, that change in expectations for rate cuts, have come on the back of what are inflationary pressures that have continued to remain persistent. We've seen inflation tick up across the board here again. We just saw the inflation number come out this morning, actually, just a couple of minutes ago. It looks like the headline inflation number actually came in slightly lower than expected, which is going to be positive news here for the markets. But the downside right now has really just been the labor market. There's been a pretty significant slowdown in the labor market here over the last few weeks. I'm sorry, last few months, that have really really adjusted people's expectations in terms of the strength of the U.S. economy. So, this week, the big news really was the inflation print, which we just saw here a couple of minutes ago. Because again, we just saw the PCE index, PCE inflation data a couple of weeks ago surprised to the upside, suggesting that inflation is still, heading in the wrong direction here at the moment. So today's inflation report is definitely a bit of a welcome surprise, coming in slightly below expectations in terms of that July inflation number. Earnings season is coming to a close, even though we've had one of our strongest earnings seasons in a while. But overall, equity markets, like I said, on the offensive, relatively strong, back at all-time highs, and we're looking like we are going to retest those all-time highs on the back of this morning's inflation numbers, and potentially break out here again on the S&P 500 to new all-time highs. We see the same thing here on the Qs. If we look at the Qs here, yesterday's price action did actually manage to intraday get to a new high. We expect on this morning's open, we will see a new high here again on the Qs. We did see small caps do well here last week, along with equal weight. So we've seen those two markets continue to do quite well here. As you can see, small caps just generated a buy signal here on Options Play. We're looking at that 225 level as that kind of upside target here. And if we can break above that, then we're heading towards that 242 highs from the end of last year. So small caps is definitely still quite a bit behind. But if you look at RSP, the equal weight S&P 500 index, you see that the equal weight S&P 500 index is also trying to get back to those all-time highs. It's definitely losing a little bit of ground here relative to the market cap indices, but overall market breadth still remains relatively strong here at the moment. One place that I think is still showing quite a bit of strength here is in the bond market here. We continue to see higher highs in terms of the bond market. Notice how, the trends have been basically strongly bullish here since the end of April. We've had a pretty significant move here to the upside in bonds. The one thing I will note is that there are starting to see some signs of exhaustion here. We continue to make higher highs in price action that is no longer being confirmed by higher highs with momentum. So there are some potential signs of weakness ahead with high yield corporate bonds, but at the moment these markets are still flashing on a very much risk on market here right now. And with 10-year yields pulling back here as well, we've seen TLT rally off of the lows and continue to kind of make a series of higher highs, higher lows, and we're looking for potentially continuation higher here for TLT here to the upside. So overall, the equity markets, the bond markets are looking fairly stable. Equity markets looking like they are retesting all-time highs, and bond markets, we're seeing yields drop, which are generally supportive here for equities. We've also seen business confidence, pick up a little bit here in July as well. So just overall, seemingly despite all of the risks in the market, equity investors are kind of shrugging off those risks and continuing to push higher here. There's obviously good news, with the China tariffs being pushed out another 90 days. So that is no longer imminently on the horizon in terms of risks. But you still have geopolitical risks with Trump and Putin meeting on Friday. So there's but with earnings season coming to an end, with inflation and jobs number recently published, I think that clears the path here for equity investors to potentially see further strength ahead. So with that, looking at the ideas here for today, what I'm going to focus on is going to be a lot more of ideas on the bullish side, because we clearly, are seeing a strong market and relatively limited ideas here on the bearish side. So the first one I want to take a look at here is BDX. Now, Becton Dickinson is the largest medical devices equipment maker here. As you can see, the stock has not performed particularly well this year. This was a $250 stock at the beginning of the year, traded all the way down to this 160 level here, so lost quite a bit of value here. But over the last few months have kind of consolidated and started to form this bottom here. And just last week, it started to break out here above that 185 level here to the upside. Our first upside target is filling this gap at 202. Our secondary upside target is closer to 225 here to the upside. Now, Benedict Dixon trades at a pretty significant discount to its industry. It doesn't grow as fast as its industry, not quite as profitable as the average stock in its industry, but it trades at a nearly 40% discount to the average. And that's really where I think the valuations remain incredibly compelling, even though it's not potentially as attractive as some of the stocks in its sector. The valuation is so low that I think it makes some sense to potentially take a look at BDX. The next one I want to take a look at is Lowe's. You can look at Lowe's or Home Depot, in my opinion. Both of these, I think, are reasonable opportunities here. Similar type chart setup to what I just showed you with BDX. This is the stock that was a $280 stock here at the end of last year, traded all the way down to 200 roughly, and then spent pretty much most of this year kind of forming this big base here between, call it 235 and 215, forming this big base and recently just broke out here to the upside. That's why our upside target here for lows is around 265, which is around the highs that we saw here earlier this year. That's our upside target here for lows. And if you look at valuations, Lowe's compared to Home Depot is much cheaper, which is why between the two, it's the one that I prefer playing at the moment. It's trading around 19 times forward earnings, even though it's expected to grow basically in line with the industry. But it's more profitable than the industry. And that's why, even though it's trading at a discount, even though the fact that it's trading at a discount for me means that it should very much be trading closer to the industry average, which is closer around 23 and a half times forward earnings, which would overlay with that $265 upside target here relatively well. And that's a good example where you get technical analysis and fundamentals aligning on kind of price levels, and makes those upside targets far more solid as a place to shoot for if you're looking for long opportunities here for lows. And like I said, you can take the same opportunity, same chart setup here for Home Depot. The only thing is that Home Depot trades at a slightly higher valuation than Lowe's. It's actually slightly higher than average. The next one to take a look at here is Amazon. Amazon reported earnings recently. The stock took a bit of a hit here, and I think that hit is an opportunity here to the upside. Amazon is by no means a cheap stock. It's trading at nearly 36 times forward earnings. But if you look at growth expectations, you look at how profitable they are, I think you could justify these valuations around 35, 36 times forward earnings, especially if you look at the technology stocks that enable AI AI in terms of a cloud computing service. Amazon Web Services is clearly a leader in that particular space. And we also have seen retail sales, that has suffered quite a bit here in the first half of 2025, seem to be breathing a little bit of life here towards the second half of this year. So we really see a bit of a double prong investment thesis here in Amazon on both the retail e-commerce side as well as on the AWS side. But obviously we expect more growth out of the AWS side and their expansion into further AI-related computing power for everyday tech firms or everyday firms to utilize their tech stack in order to power their internal AI systems. And Amazon very much is in the fight to win that business from as many small, medium, and large size enterprise corporations that utilize AWS as their cloud hosting solution. And that's really where I think there's some upside potential here for Amazon. The next one I'm going to take a look at here is, let's look at Block XYZ. Let's talked about this quite a few weeks in a row now, and the stock, we started liking the stock when it started breaking out here above $60 here or so. As it broke out here above 63, that's really when we started adding to this position here. And the stock recently did pull back, basically filling the gap. So it gapped higher here, came back to refill that gap. And that's really where I think the risk reward looks quite favorable to add some further upside exposure here for XYZ. And XYZ trades at around 16 times forward earnings, which is a pretty significant discount to its peers, about 40% discount. So it's a big discount in terms of valuations. Yet it's expected to grow top and bottom line significantly faster than its peers. And then on top of that, the cherry on top is the fact that it's even more profitable than its peers. So the fact that it trades such a heavy discount represents, in my opinion, a pretty interesting opportunity for for XYZ investors to take advantage of the recent pullback here to add some bullish exposure. The next one I want to take a look at here is Alphabet. We've been talking about Alphabet here for quite a few weeks now, and the stock has effectively gotten back to basically fill this 202 gap that it created back here in February of the year. So we're looking for that gap to get filled and then potentially break out here from there, kind of forming a bit of a double top and breaking out, which would be a pretty strong bullish signal here for Alphabet long term. Now, Alphabet, like unlike other tech companies, trades at a valuation that I think is far more reasonable given its growth rates and its profitability. It's trading around 21 times forward earnings, which is quite inexpensive for the Mag 7 tech stocks that are all chasing AI supremacy. Growth expectations are in the 11-12% range for EPS and revenue, which is respectable. Net margins are 31%, which are industry leading. So the fact that it still trades at a discount relative to its peers, not a huge discount, but a discount relative to its peers, is really what I believe provides that upside opportunity here. And the timing is quite optimal given that it recently broke out above that 195 double top on Alphabet. And the last bullish idea I'll leave you with here is one that I've also been talking about for quite a few weeks now, which is Micron. Micron, as you can see, is trading recently. It traded as high as 130, pulled all the way back to this 110 level here or so. That's really when we started looking at adding Micron again, and the stock is really starting to take off here again. So this is a great opportunity to shoot for that 130 double top and potentially see if we can get back above that here as well. So Micron, up about 10% here in just in the last couple of days. Still trading around 10 times forward earnings at this point. But if you look at growth expectations, we're talking about numbers that kind of look like Nvidia, and the reason for that is because they are one of the primary suppliers of high bandwidth memory chips that go into the Nvidia GPUs. So if you're looking for opportunities to invest within the AI infrastructure build out theme, the obvious plays there are Nvidia, Oracle, Supermicro, those types of companies. But those companies are also already trading at very rich valuations. So it's hard to justify, even if you believe in the theme and you believe in those particular companies, it's hard to continue to press longs at those valuations, hoping that they'll continue to stretch even further. So my preference is to take a sort of under the radar name like Micron that produces a lot of the components that go into the NVIDIA GPUs and pick that up at a much more reasonable valuation at around 10 times forward earnings. Now, with that, let's take a look at some of our bearish ideas here for the week. The first one I wanted to bring up here is Philip Morris. We've seen Philip Morris, it's been a strong stock, but in the last couple of weeks, it really started to underperform here. Broke down below this call at 175 level here, broke down, came back, starting to come back to retest this level of resistance, and that's really where I see some potential downside opportunity here. Now, Philip Morris trades at 23 times forward earnings, which is nearly 30% higher than its peers. Yet, if you look at growth expectations, they are higher than the average tobacco stock. But if you look at net margins, meaning how profitable they are, they've really struggled with profitability over the last few years and actually continue to continue to see margin compression over the last few years where they're making more money, they're making more in terms of revenue, but they're not turning that revenue into profits in the same way. So the stock is getting more expensive on an earnings basis, but also on a revenue basis, it's also getting expensive here as well. And that's why with the recent price action, the breakdown below that major support level as it goes back to retest it as resistance, that's really where I think the most optimal entry point for these types of trades are going to be. And then let's see. The other one I want to take a look at here is CrowdStrike. Basically, like the stock, when it started to break down here below this, call it 475 level here, call it 470, 475. Ever since it broke down below that level, it just continues to trade lower here, and we're looking for, a downside target here of 420. So we're very close to our downside target here right now. We'll continue to monitor that over the next couple of days and see if we get any further downside. Otherwise, I think this is one that we do start thinking about taking some profits, even though from a technical, even though from a fundamental perspective, I think this this particular stock is quite overvalued. It's trading at 120 times forward earnings, which is somewhat understandable because they're just turning profitable. A lot of stocks that are just turning profitable, because the denominator in the PE ratio is so small, it pushes the overall number to look very big. But CrowdStrike is not just expensive on an earnings basis. It's incredibly expensive even on a revenue basis. It's trading at 26, 27 times revenue. I remember in sort of the heyday of the pandemic, a lot of those Chinese EV stocks, all the stocks that were kind of hyped up during that period, the extent of what they were trading at is probably around 20, 22 times forward earnings. But CrowdStrike trading at 27, I'm sorry, when I said 20 to 20, I meant a multiple of revenue. So when I look at CrowdStrike, it's not just expensive on an earnings basis because they just turned profitable and that denominator is very small, but if you look at it if you look at the valuation on a revenue basis here as well, it's also incredibly expensive, and that's why I have a bearish view on this particular stock, and it's just about finding the right entry points using the charts as to find the most optimal entry point for these specific ideas. So with that covers what I wanted to share with you here today. Hopefully this gives you some idea as far as what my views are from a macro perspective. It looks like things are quite positive here for the overall markets. And then some of the ideas to potentially trade during today's trading session. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.